This isn't about genius. It's not about predicting the future or having insider information. These are my rules. Rules that turned $18 million into $14 billion. Rules that worked for ordinary investors who paid attention. Rules that can build your wealth if you're disciplined enough to follow them. I didn't outsmart the market, I outworked it. I out-researched it, and I stuck to principles that Wall Street laughed at while I was beating them year after year. I'm Peter Lynch, and now I'm going to give you the same rules I followed, the same principles I lived by, so you don't have to stumble in the dark like most investors do. Follow my rules or watch your portfolio go nowhere. Before we begin, subscribe now, like this video, and leave a comment. That simple action helps more people see this content, and it tells me that sharing these lessons still matters. Now listen closely, because these rules were forged over 13 years of beating the market, managing billions, and never losing sight of what actually works. Invest in what you know. The edge is already in your life. There is no rule more misunderstood and more powerful than this one. You already have an advantage that professional investors would kill for. You just don't know it yet. The market is never as mysterious as Wall Street wants you to believe. The opportunities aren't hidden in complex algorithms or insider boardrooms. They're in your daily life, right in front of you, if you just open your eyes. Let me tell you a story. When I was running Magellan, I made one of my best investments because my wife came home from the mall. She was excited about this store. The parking lot was always packed. The products were flying off the shelves. She kept going back. That store was the gap. I didn't need a Wall Street analyst to tell me it was a good investment. I just needed to pay attention to what was happening in the real world. Most investors ignore this advantage. They think investing means buying whatever CNBC is shouting about or whatever their broker recommends. They're looking for complicated answers when the simple ones are staring them in the face. You work in healthcare? You probably see which medical device companies are actually being used by doctors. You're a teacher? You know which educational software companies are making a difference. You shop at grocery stores? You notice which products are consistently selling out. This is your edge. This is what professional investors sitting in Manhattan offices don't have. They're reading reports about consumer trends while you're living them. But here's the critical part most people miss. Knowing about a company is not the same as knowing it's a good investment. You still have to do the work. You still have to look at the financials. You still have to understand the business model, the competition, the growth prospects. Investing in what you know doesn't mean buying every stock connected to your life. It means starting your research with companies you can actually understand and evaluate. It means you have a framework for determining whether that packed parking lot translates to sustainable profits. The average investor has this backwards. They buy first, research later, or worse, they never research at all. They just assume that because they like a product, the stock must be good. That's not investing. That's hoping. I made money at Magellan because I combined ground-level observation with rigorous analysis. I'd notice a trend, then I'd dig into the numbers. I'd visit the stores, I'd talk to management, I'd compare it to competitors, I'd look at debt levels, profit margins, growth rates. The invest in what you know principle is the starting point, not the finish line. It tells you where to look. The work tells you whether to buy. Never invest in any idea you can't illustrate with a crayon. This rule saved me from more disasters than any other. If you can't explain why you own a stock in simple terms, terms a child could understand, you don't actually understand it. And if you don't understand it, you have no business owning it. Wall Street loves complexity. They love jargon. They love making things sound sophisticated because complexity sells services. But complexity is the enemy of good investment decisions. I once sat in meetings where analysts pitched me investment ideas that required 20 slides and an advanced degree to understand. I'd stop them and say, "Explain it to me like I'm in 5th grade." Most of them couldn't. That told me everything I needed to know. Compare that to my best investments. Dunkin' Donuts sells coffee and donuts to people who want breakfast. Simple. Home Depot sells tools and materials to people fixing their homes. Simple. Coca-Cola sells a beverage people love all over the world. Simple. These weren't unsophisticated businesses. They were sophisticated businesses with simple value propositions. There's a massive difference. When you can explain your investment thesis simply, you can evaluate whether it's working. You can track the relevant metrics. You can identify when something's changing. But when your thesis is complicated, when it relies on obscure financial engineering or speculative future technologies, you're just gambling and calling it investing. Here's how I tested this. Before I bought a stock, I'd imagine explaining it to a relative at Thanksgiving dinner. If I couldn't make them understand why this was a good investment in 2 minutes without using industry jargon, I knew I didn't really understand it myself. This discipline forced me to focus on fundamentals. What does the company do? Why do people buy their product? How do they make money? What advantages do they have over competitors? Why will they still be relevant in 5 years? If you can't answer those questions clearly and simply, move on. There are thousands of stocks out there. You don't need to own the complicated ones. In fact, you should avoid them. Because when things go wrong, and they always eventually go wrong somewhere in your portfolio, you need to understand what's happening well enough to decide whether to hold or sell. If you didn't understand the business going in, you'll panic and make the wrong decision coming out. Simplicity isn't about being unsophisticated. It's about being clear. It's about knowing exactly what you own and why you own it. That clarity is what allows you to hold through volatility, to add to positions when they're down, to recognize when the thesis has actually changed versus when the market is just being the market. You make money in stocks by not losing money in stocks. This sounds obvious, but almost no one acts like they believe it. Everyone wants to talk about their winners. Nobody wants to discuss how they protected themselves from the losers. But here's the reality. 1 or 2 massive losses can wipe out years of gains. I didn't beat the market for 13 straight years by hitting home runs on every investment. I beat the market by not striking out catastrophically. I hit a lot of singles and doubles, and I avoided the zeros. The way you avoid losing money is remarkably simple, but it requires discipline most investors don't have. First, you never overconcentrate. I don't care how certain you are about a stock. I don't care if you think it's the next Microsoft. You never put so much into one position that if you're wrong, you're done. Even my highest conviction ideas at Magellan never represented more than a certain percentage of the portfolio. Why? Because I was wrong all the time. Everyone is. The question is whether you're wrong in a way that destroys you or in a way that merely disappoints you. Second, you avoid companies with too much debt. Debt is cancer to a portfolio during bad times. A company with a strong balance sheet can survive recessions, industry downturns, strategic mistakes. A company leveraged to the hilt is one bad quarter away from disaster. I've seen countless sure things go to zero because they borrowed too much and ran out of runway when things got tough. Some of the best businesses in history have destroyed their shareholders because management got greedy with leverage. Third, you actually look at the financials. This seems basic, but you'd be shocked how many people buy stocks without ever reading the annual report, without looking at the balance sheet, without understanding the cash flow. They buy based on a story, a recommendation, a feeling. That's not investing. That's financial Russian roulette. I spent my career reading annual reports, hundreds of them, thousands. It was boring, it was tedious, it made my eyes hurt, but it kept me from buying companies that looked good on the surface, but were quietly falling apart underneath. Do you want to know how to not lose money? Don't buy what you don't understand. Don't overconcentrate. Don't ignore debt. Don't skip the homework. It's not exciting advice, but it works. Every single investor I know who went broke ignored at least one of these principles. Usually all of them. The stock market is not the economy. Price is not value. This is where most investors get confused, and it costs them dearly. The stock market and the economy are related, but they're not the same thing. The market can crash while the economy is strong. The market can soar while the economy is weak. Why? Because the market is forward-looking and emotional, while the economy is backward-looking and factual. More importantly, the price of a stock today has nothing to do with whether the company is good. Price is what you pay. Value is what you get. And they're often dramatically different. I bought some of my best investments when everyone hated them. The stocks were down, the media was negative, other investors were selling. But when I looked at the actual business, the fundamentals, the competitive position, the management, the growth prospects, I saw value far exceeding the price. That disconnect is where money is made, not by buying what's popular, by buying what's valuable. The reverse is equally important. I passed on countless hot stocks that were trading at insane valuations. Yes, they were growing. Yes, they were exciting. Yes, everyone wanted them. But the price already reflected perfection. There was no margin of safety. One stumble and you'd lose 30, 40, 50%. That's not investing. That's speculation. There's nothing wrong with speculation if you know that's what you're doing. But most people don't. They think they're investing in great companies when they're really just buying overpriced stocks. Here's a framework I used constantly. I'd look at a company's earnings, its growth rate, and its price. If a company was growing earnings at 15% annually, and the stock was trading at a PE ratio of 10, that was interesting. If the same company was trading at a PE of 40, I'd move on. Why? Because at 40 times earnings, the market is expecting perfection. And perfection never happens. Something always goes wrong. A competitor emerges, a product disappoints. Management makes a mistake. And when that happens to an overpriced stock, the decline is brutal. I made more money by avoiding overpriced stocks than I ever did by picking perfect winners. Because avoiding the big losers, avoiding the situations where you overpay for a story, keeps you in the game long enough for compounding to work its magic. You can't compound if you keep blowing up. Time, not timing, is what builds wealth. Let me destroy one of the most pervasive myths in investing. The idea that success comes from timing the market, from getting in at the bottom and getting out at the top, from predicting crashes and rallies. It's nonsense. Complete nonsense. And I can prove it because I never did it. Not once in 13 years of beating the market did I successfully time the market consistently. You know what I did instead? I stayed invested. I held good companies through volatility. I added to positions when they were down if the fundamentals hadn't changed. I let time do the heavy lifting. Because here's what actually matters. A good company held for 10 years will make you wealthy. The same company traded in and out based on trying to time moves will leave you with mediocre returns and a lot of stress. The math is simple but powerful. If you invest in a quality company growing earnings at 15% annually and you hold it for 10 years, you'll multiply your money several times over. But if you try to trade it, if you sell when you think it's topped and buy when you think it's bottomed, you'll miss the best days. And missing just the best 10 days in a decade can cut your returns in half or more. I've seen the studies. They're not debatable. The market's biggest gains happen in concentrated bursts, often during volatile periods when people are scared. If you're out of the market trying to time the bottom, you miss them. Here's what I did at Magellan that nobody wanted to hear about. I was boring. When I found a good company at a reasonable price, I bought it. Then I held it. I didn't check the price every day. I didn't panic when it dropped. I didn't get clever and take profits after a quick gain. I just held, and held, and held. As long as the business fundamentals remained strong, I stayed in. Some of my best performing stocks I held for years. Many of them were down significantly at various points. If I'd tried to time them, I'd have missed massive gains. The investors who make real money in stocks are the ones who can sit through drawdowns, who can watch a position drop 20 or 30% and not panic if the business itself is still solid, who can ignore the noise, the headlines, the daily volatility. That's not easy. It requires psychological strength most people don't have, but it's the only way to let compounding work. The best stock to buy may be the one you already own. This might be the most counterintuitive rule I can give you, but it's one of the most valuable. Wall Street makes money when you trade. Your broker makes money when you trade. The financial media keeps you watching by suggesting you should always be doing something. But the truth is, the best investment decision is often to do nothing. To hold what you have if it's working. I can't tell you how many times I've seen investors sell a great stock because they got bored with it. It wasn't exciting anymore. It wasn't the hot new thing. They wanted action. So they sold a solid company with great fundamentals and growing earnings to chase whatever was trending. What happened? The stock they sold continued climbing. The stock they bought disappointed. They ended up poorer and more frustrated. Here's a framework. Before you sell a stock to buy something else, ask yourself this question. If I didn't already own this stock, would I buy it today at this price? If the answer is yes, don't sell it. Keep holding. Only sell when the fundamentals have deteriorated, when the competitive position has eroded, when the story has changed. Don't sell because you're bored. Don't sell because you want to feel like you're actively managing your portfolio. I held some stocks at Magellan for the entire time I ran the fund. They weren't sexy. They didn't make exciting stories. They just kept growing earnings, kept gaining market share, kept rewarding shareholders. While other investors were churning their portfolios, I was compounding. That's the secret. Not activity, consistency. The best investors I know have very low turnover. They find good companies and they hold them. Forever, if possible. This doesn't mean you never sell. It means you sell for the right reasons. You sell when the thesis breaks, when the company takes on too much debt, when a better competitor emerges, when management makes terrible decisions, when the valuation becomes absurd. But you don't sell just because the stock went up. You don't sell just because you've held it for a while. You don't sell just because something else looks interesting. Those are emotional decisions. Emotional decisions destroy wealth. Your best ideas are probably ideas everyone else missed. This is where individual investors have a massive advantage, and most of them waste it. Wall Street analysts cover the same 2,000 companies. They all read the same reports. They all talk to the same managements. They all think the same thoughts. That's why they all have similar performance. They're fishing in the same pond. But you have access to 10,000 companies they're not watching. Small companies, regional companies, boring companies that don't make headlines. Some of my best investments at Magellan were companies no analyst followed, companies too small for big institutions, companies doing boring things in unsexy industries, companies the media never mentioned. Why were these such good investments? Because nobody was competing with me. The stock wasn't priced for perfection because nobody was hyping it. I could buy quality businesses at cheap prices. I'd walk through malls and notice regional retailers that were executing brilliantly but nobody in New York had heard of. I'd read trade publications and find equipment manufacturers that dominated their niches. I'd talk to industry insiders and discover distribution companies that were critical but invisible. These weren't lottery tickets. These were real, profitable businesses with competitive advantages. They just weren't famous. The individual investor can do this. You probably already do this in your daily life without realizing it. You notice companies before Wall Street does. You see trends before they become mainstream. You recognize quality execution before it shows up in the numbers. But then you ignore your own observations because you think the professionals must know better. They don't. They know different things, but you know things they don't. The key is to trust your observations but verify them with analysis. When you spot something interesting, dig deeper. Look at the financials. Understand the business model. Compare it to competitors. Figure out if what you're seeing is sustainable or temporary. But don't dismiss your own insights. Some of the best investment opportunities are hiding in plain sight, visible to anyone who's paying attention, but invisible to the herd. Success in investing is mostly about avoiding stupidity. Let me end with this because it's the most important rule of all. You don't need to be brilliant to make money in stocks. You don't need to find the next Apple in 1980. You don't need to predict the future. You just need to avoid making the catastrophically dumb mistakes that destroy most investors. The investors who fail aren't stupid people. They're smart people who do stupid things. They chase hot stocks without understanding them. They panic and sell at bottoms. They overconcentrate in one sector. They ignore debt. They try to time the market. They listen to tips instead of doing research. They let emotions override logic. I wasn't the smartest guy managing money, but I avoided most of those mistakes most of the time. I did the boring work. I stuck to my principles. I didn't get fancy when simple was working. I didn't gamble when I could calculate. I didn't hope when I could analyze. That discipline, that consistency, that willingness to be boring, that's what beat the market year after year. You want to succeed as an investor? Stop trying to be brilliant. Start trying to be disciplined. Stop chasing excitement. Start seeking value. Stop trading. Start investing. Stop listening to noise. Start doing homework. Stop following the crowd. Start thinking independently. These aren't sexy rules. They won't make you feel like a genius, but they work. They worked for me. They've worked for every successful long-term investor I've known. And they'll work for you if you're patient enough, disciplined enough, and humble enough to follow them. Follow my rules or watch your portfolio go nowhere. If these words resonated with you, it means you're serious about investing. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content. And it tells me that sharing these lessons still matters.